Hey guys, welcome back to Smart Buys by Erin, Real Talk in Real Estate. I'm Erin Blasick. I am your real estate advisor, serving Louisville, Kentucky and the surrounding areas, helping buyers and sellers buy smarter. All right, guys, so today we're going to talk about something that surprises almost every first-time home buyer, and honestly, it's one of the biggest reasons people end up stressed after they start house hunting, and that is how much house you can actually afford versus what the bank says you can afford. Because those two numbers, they're not the same. Surprise! So let's get into it. Okay, first of all, why does this happen? Why would a lender give you more money than you should spend? So here's the thing. Here's the honest, blunt truth. Lenders are in the business of lending money. Their job is to figure out the maximum you qualify for based on your income, your credit score, your debt to income ratio, and that's it. They're looking at your financial profile on a piece of paper. What they are not factoring in is your lifestyle, your grocery bill, the gym membership, the fact that you may need a new car next year, you'd like to take 2 vacations a year. They are not knowing how you're living. They just know what you look like financially on paper. So when a lender says, "Congrats, you're approved for $450,000," they're not saying you should spend $450,000. They're just saying that's what we are willing to lend you to borrow up to $450,000, and there's a big difference. So, how do you figure out what you can actually afford? Let's break it down in a simple way. A rule of thumb, you guys, I'm sure you've heard a lot, is the 28-36 rule. And the idea is that your housing costs, your mortgage, your property taxes, your insurance, because that's going to be all rolled into your payment, should not exceed 28% of your gross monthly income. And your gross monthly income, guys, is the income before taxes, 401k, healthcare, all that stuff comes out of your check. And your total debt, including your car payment, student loan, credit cards, that should not exceed 36 of your gross monthly income. Now, I'm going to be honest, I get it. In today's market, guys, people are stretched, and they stretch a little bit past that point, and I get it. But it's still a great starting point, okay? Here's what I want you to actually do, though. Sit down, look at your monthly take-home pay, not the gross, the take-home, what you're getting in your check, what's hitting your bank account, then write out every single monthly expense you have and be honest. Don't leave out the streaming services. Don't leave out the eating out. Legitimately look at what you spend every month. And you're going to take that net income, subtract all of your expenses, including what you would like to save too, right? If you want to do some savings, take that out. What's left over, all of that, that's your real number to work with for a mortgage. And remember, your mortgage payment isn't just principal and interest. You're going to have homeowner insurance in there and property taxes. And side note, if you don't put down 20%, which I know a lot of first-time home buyers don't, right? No shade here. But just know that if you don't meet that 20% threshold on the down payment, you will be also charged PMI until you reach that 20%. So this is a temporary fee that you will see in your monthly payment as well. And that can last 5, 6, up to 10 years. So understand that as well. Let's talk about an additional thing, the part that really nobody warned you about in connection with the lender lending you more money than you actually want to spend. This is the emotional side of buying, guys. This is when it comes into the part of the process of searching for a home. This is going to happen. You are going to walk into a home that is just beautiful. It's got the open kitchen, the natural light, the backyard, and your brain is just going to go there. You're already mentally decorating. You have found the one. In that moment, it is so easy to say, you know what, I'll just make it work if you're already stretched past your budget. Please be careful not to fall into this pitfall, because what's going to happen is, and I hear this all the time, and I get it, I really do, making it work can mean skipping vacations. It's meaning being stretched on bills sometimes, not being able to save for retirement. These are important. We're buying our house for two reasons, right? Number one, we need shelter. Number two, this is a smart investment. But we don't want to send ourselves into a financial spiral. That's not how we want to live. That's not a good place to be. And being house poor is a real thing. That's when you technically own a home, but you're so stretched on your payments that all you do is work and go home. And you can't enjoy your life. And that's not the point of this. The goal is to have a home that fits your life, not a home that is your life at the expense of everything else, right? So, to all my first-time home buyers out there, listen up. These are some practical tips that we're going to use before we even start talking to a lender, which is why we're covering this today. So before you talk to a lender, set your own comfortable monthly payment. Know your number going in so you're not anchored to whatever they approve you for. Number 2, get pre-approved. We know this, right? But use the pre-approval as a ceiling, not a target. You need the pre-approval because nobody's going to accept your offer without it. You need to know about where you land in the budget. But just because you can borrow $450 doesn't mean that you should be looking at those homes. And you may be able to afford that. I'm not saying that. But a lot of times people rely, like I said, on the lender to tell them what they can afford. They cannot tell you that. That is your job, guys. This is your money. This is your life. 3, use an online mortgage calculator to get there and play with the numbers. Plug in different home prices. See what that monthly payment actually looks like. Call home insurance companies and see if they'll give you estimates. And they will. Understand when you're looking in these neighborhoods too, what's the property tax, guys? All different sides of town have different property taxes. If you like a particular area or a particular neighborhood, know what that property tax is. So you can logically factor that in. And lean on your real estate agent for this, guys. They can help you kind of navigate through some of this. A lot of first-time homebuyers are shocked when they see that real number. But let's go in knowing the real number so that we're armed with the knowledge and the power that we need. Number 4, give yourself a buffer. Life happens, guys. You're going to want some breathing room in your budget, repairs, maintenance, and just living. So it goes back to that original budget that we put down. What are our monthly expenses? What do you want to put away every month as savings for emergencies? And 5, talk to a financial advisor, a HUD-approved housing counselor, if you really want the clear picture. There are free resources out there specifically, guys, for first-time home buyers. So, guys, just to wrap it all up, getting pre-approved for a big number feels great, and it's an important step, but your lender's job is not to protect your budget, okay? That's your job, to protect your budget. It's your money. Let's get comfortable knowing what we can afford and sticking to it. We want you to love your home and your life, and both are possible. We just have to go in with our eyes wide open. And that is it, guys, for today's episode of Smart Buys by Erin. If this was helpful, share it with a friend. Reach out to me on Instagram or Facebook at homesbyerin_. DM me. Feedback, questions, all are welcome. Because this is the kind of stuff nobody tells you about until it's too late. Happy house hunting, guys. See you on the next one.